Welcome back to FT Markets. The temperature is hotting up in global bond markets. The big fear of investors is that the turbulence we've seen in the last few weeks might be the start of the big one, the reversal of the bull market we've seen over the past 30 years that have sent interest rates to historic lows. With me to discuss whether we might be at that point is Trevor Greetham, who is the head of multi-asset at Royal London. Trevor, welcome to the Financial Times. If we look at our first chart, just to show the movements we've had in recent months, most dramatically in German 10-year bund yields. These are quite big jumps we've had, a lot of volatility and things going up and down on a daily basis. Has this taken you aback in the last few weeks?
Well, actually, we've been underweight bonds for some time, and we were expecting bond yields to rise during the QE from the ECB, which was what happened in the past. And now we're seeing it happen. I think the trigger was probably some dollar weakness and the pop in the oil price.
Both sides of the Atlantic. But if we look at this, and what we've done for our second chart is put this into a much longer term historical perspective. And you can see that in various episodes, 94, 98, we've also seen big moves upwards. What triggered those moves?
Well, those were generally triggered by a strong growth, rising inflation backdrop. And just to put things into context, the sell-off we've seen in US Treasuries so far this year has been just short of 5%. In bunds, it's been about 6%. In 1998 and in 1994, which were periods of strong growth and rising inflation, the bond markets lost you more than 10% in both instances.
So what we've seen so far is not yet comparable with anything like we saw in...
It's not, and the reason for that partly is that central banks haven't done anything to tighten policy yet, so it's more like the taper tantrum so far.
2 years ago. Of course, when you have bund yields, particularly at such low levels, even relatively small moves in the yields can make a big difference to returns, though. So
they can, because you're not getting the income to cushion the losses on capital, and the duration has lengthened as the yields have dropped. So people are calling it return-free risk instead of risk-free return.
Okay, now the big question, of course, is whether that long-term trend we've had, ever lower rates, is now going to go slowly to reverse, having hit almost the zero. Now, you have a neat way of looking at the world of economies and financial markets. Your investment clock, which we've drawn up very prettily in our graphics people here. Just perhaps you could explain in just a few seconds what this is showing, then I can ask you what it means now.
Okay, well, this is a way of thinking about how different assets perform at different stages of the business cycle, and that the up-down direction is growth. So if you've got strong growth, you're in the top half, and the left-right direction is inflation, rising inflation, you're on the right-hand side, and the nemesis for bonds is the overheat section, where you've got strong growth, rising inflation, and commodity prices
Is that where we
well.
were in 94 and 98?
It's where we were in 94, it's where we were in 98. It involves a rise in real yields because there's a lot of demand for capital. Commodities are going up, so inflation expectations rise, and the central banks are hiking rates.
And in the middle there, you've put what it means for different sectors, in equities, presumably.
Well, that's right. I mean, the really critical thing at the moment, though, I think, is where we are in terms of bonds. So if you've got strong growth and falling inflation, which is what we've seen for the last few years, it's great for stocks. We could be entering the overheat, which is okay for stocks, but starts to see losses on bonds.
How can you say we're overheating when we have inflation at such incredibly low levels in the UK, across Europe, and even in the US?
Well, technically we're not yet. So at the moment, the inflation indicators still put us at the top left-hand corner, so the sort of stock market boom period like the 1990s. But I think if you look to the second half of the year, especially if the dollar is a bit soft and the oil price is rising, especially if China shows some response to stimulus, the year-on-year base effects of oil are going to change very quickly, and you're going to see a more inflationary feel.
So the flames are still quite low, but they could suddenly flare up, is what you're saying?
I think so, and I think the fact that you've seen this big rise, 25% rise in Brent over the last couple of months, that's got people thinking about inflation in the second half of the year. It could still turn out to be another false alarm like the taper tantrum.
But Trevor, we're in a quite different world to 94, 98 because of the impact of quantitative easing, which has had all sorts of unforeseen consequences in the way financial markets work. Is it sensible to make these sorts of comparisons, do you think?
I still think they're valid. I think with QE, you often get a rally in the bond markets in anticipation, and maybe it lasts a little while into the QE. But then if growth is picking up and inflation's rising, the central banks will welcome it. So we had a comment from an ECB speaker this morning, Curre, and he was actually trying to say we'd welcome a rise in bond yields if it's because the economy is recovering and QE is working, but not quite this fast, please.
Okay, I'm going to put you on the spot. Last question. Do you think we're at the end of that 30-year bund rally?
I think we probably are, but I think we could see sort of volatile trading markets for a while.
Trevor, thank you very much. So prediction there that maybe the 30-year bull market is coming to a close and a lot of volatility ahead.